Welcome to our Taking Stock video for the week ending the 12th of July 2024. I'm Kien Trinh, Head of Research at Stock Doctor, and today I'm joined by our Senior Equities Analyst, Jason Yin, to stream to you all things share market. Welcome, Jace. How are you today?
Very good, Kien. It's always great to be on.
It's great to have you as always, Jace. But before we get started, just a quick yet important reminder, the information we provide today is of a generic nature and therefore shouldn't be considered personal advice. Remember, shares are volatile, so any past performance figures shouldn't be relied upon as a guide for future performance. Well, Jace, it's been quite a positive week for the Australian equities, spurred by record highs achieved on the US market as investors price in a soft economic landing, meaning lower inflation without the recession. In fact, we had June CPI figures dropping by about 0.1% month on month, and this translates to an annual inflation rate of about 3%. And now markets are pricing in a 90% chance that interest rates will be cut in September in the US. But here in Australia, though, economic growth remains quite weak and core inflation is still stubbornly high at 4.4%. And with tax cuts coming into effect this financial year, interest rates here are expected to remain higher for longer.
Yeah, it is definitely a different dynamic here in Australia, Kien. But as we approach the FY24 reporting season, it's actually important to focus on the risk of your portfolios. And what does that mean? Well, consider removing or reducing exposure to financially unhealthy businesses and stay diversified by holding at least 15 stocks to help you manage any adverse share price movements from any individual results. And lastly, it's also prudent to actually take some profits off the table, especially on stocks that have rallied strongly on the back of this positive sentiment. Having some cash on the sidelines will allow you and give you some dry powder for any oversold opportunities during reporting season.
Yeah, good advice there, Jace. But heading into the reporting season, though, consensus is anticipating corporate earnings to fall by about 6%, with most of this decline driven by resources. If we exclude this, though, earnings growth for the industrial sector is expected to be modest at around 8%. But let's drill deeper here. And rather than look at those growth forecasts, it's more useful to look at the change in earnings expectations over time because it helps us understand the areas of strength and vulnerability across the markets. And the chart on screen breaks this down with the 3-month earnings revisions across the different sectors.
Yeah, that's right, Ken. And also outside of resources, which have been impacted by falling commodity prices, the areas of the market that appear most vulnerable at this stage include media, building materials, supermarkets, utilities, and of course, financial services. On the other end of the spectrum, technology, transport, food products, and healthcare are expected to perform well.
Yeah, again, Jace, it's about the risk management, especially in managing those vulnerable sectors. But a key issue we will be monitoring over the reporting season will be their net profit margins. With the slowing sales growth that we're seeing and inflation and debt cost pressures still lingering, margins along with financial health will be the factors which will help us identify strong businesses from the weak ones. And speaking about the margins, Jace, last week we had borderline star growth stock and mining software business, RPMGlobal. They released a trading update, which disappointed the market. So can you give us some insights into this?
Well, Ken, the stock had a very strong run in FY24, which was due to a positive first half 24 result and also growing expectations from investors of a potential upgrade and for management to upgrade their guidance. But keep in mind that the stock has very few analysts covering it, and therefore there is a lot of uncertainty in terms of that earnings outlook.
And at its trading update last week, management did confirm that underlying earnings will miss previous expectations. And this was due to the transition from perpetual licensing sales, where a bulk of the revenue is booked, versus SaaS or software as a service model, where revenue is more incremental.
That's right, Ken. And this transition has not been reflected in the earnings revisions because of the lack of analyst coverage.
Yeah, but similar to what occurred with other software companies such as Objective Corp and also Technology One, by moving from perpetual licensing to SaaS, it can be quite difficult for management to forecast the mix of sales between recurring revenue and also perpetual licenses.
That's a good point. And given the strong performance since Star Growth stock initiation, the team has decided, we feel that the upside is rather limited at this stage. So that's why the team has decided to move its status to a borderline Star Growth stock. We will provide a further assessment of the company at its full year results in August.
Yeah, that's coming up pretty soon, Jason. In other news, we had Star Income stock Telstra. They announced a price rise of around $2 to $4 per month. And that price rise is to increase their postpaid mobile plan prices earlier this week. At the midpoint, though, this should translate to roughly a 3% rise in the average revenue per user for their postpaid mobile services. And this has led, obviously, to a share price recovery on the stock.
Yeah, that's right. Who would think that $2 to $4 would actually make a big difference? But consider this, mobile services contributed to 49% of Telstra's total revenue. So in operating terms, i.e. gross profit net of operating expenses, it actually accounts for 65% of the group's earnings. Now, this highlights the margin benefits from the mobile division compared to Telstra's other divisions.
Yeah, and with that in mind, Jace, the 3% increase in mobile's revenue would result in approximately a 4 to 5% increase in its earnings. And this should help improve its free cash flow, especially in financial year 25, and support its dividend at currently around 19 cents per share for that year.
The payout ratio is also pretty high at around 100%, but with management guiding for FY25 mid-single digit earnings growth, members can be rest assured that dividends will be well supported. In addition, there is ample cash buffers on its balance sheet and free cash flow is expected to pick up materially in FY25. The share price is currently trading on an attractive FY25 gross dividend yield of 7%. The company is due to release its FY24 results on the 15th of August with an estimated ex-dividend date of 30th of August 2024.
And now for Under the Microscope. This week, we take a look at specialist wealth platform provider Netwealth. Since its lows in November 2023, Netwealth's share price has risen by more than 70%, and that's delivered strong performance for our members' portfolios.
Yeah, it certainly has been a pretty stellar performance, Kien. Looking into the fourth quarter 24 update provided this week, it highlighted a 25% rise in total funds under administration, and the growth in new customers also appears to be accelerating over the quarter. Now, these factors are all very positive signs for the group's future earnings growth and also its return on equity. However, management did reiterate the need to be mindful that the proportion of clients on a reduced or zero fee tier is rising, and this is due to higher account balances. This means the incremental contribution to platform revenue and also its margins will likely decrease.
Yeah, that's correct, Jace. And the drivers of Netwealth's forward earnings will rely more on the number of customers it has rather than the total funds under administration. If we looked under Golden Rule 3 now, the outlook for Netwealth remains quite attractive with revenue and earnings per share growth of 20% and 27% respectively. So while management has been cautioning the market about margin erosion since April, it doesn't align with the positive 6% earnings per share revision to its 12-month forward earnings under Golden Rule 3.
Yeah, that's a good point you make about earnings revisions, Kian, but members should bear in mind that analysts tend to have a positive bias in terms of their forecasts, especially if they want to maintain strong relationships with the management teams of these companies. The share price is currently trading at the upper end of its fair value range, but with just 1 month left until its FY24 results, it might be wise for members to consider a wait and see approach before deciding what they would like to do with their exposure in this company.
Yeah, that's great, Jace. And lastly, it's important to note that Netwealth was founded by father and son duo, and the father still retains around 50% of the company. Michael, the father, has now retired, though, so leaving the management of the company to his son, Matthew.
Yeah, and believe it or not, Kian, at 74 years old, Michael has definitely earned his retirement. We have noticed, however, that the family trust has sold down 5% of their holdings over the last 12 months, and this is presumably for Michael to fund his retirement. Despite the sell down, the family still retains a lot of skin in the game, so we don't think this action warrants any yellow flags.
Earlier this week, one of our members did ask us whether they should invest in a fund manager. So, to reframe this question, and for question of the week this week, what should investors consider when investing in a listed fund manager?
Well, Ken, the first thing to understand is that the earnings profile of listed fund managers are highly leveraged to share market performance. This is why forecasts for fund managers can be rather unreliable because it is difficult to predict market movements, which in turn leads to large changes in earnings revisions despite fund managers having plenty of analyst coverage.
Yeah, so just be mindful of those forecasts for fund managers. But the other important point to consider is the management track record as well. So you've got to
Mm.
ask yourself, has the underlying funds been outperforming? And you need to be wary of investing in large fund managers for growth. Or, because our research has shown that the larger the fund manager, the more difficult it is for the manager to outperform the market over time.
Good point, Kien. You also need to be mindful when the fund undertakes a large acquisition, which is often a signal to remove the stock due to heightened risks around management changes, costs blowouts, and also the difficulty in outperforming the market with more funds under management.
Yeah, and these issues, Jace, are normally reflected in the return on equity and also the net profit margins of the company. Take, for example, with Perpetual, following its acquisition, and that it was quite a major acquisition of Pendle, the return on equity and net profit margins began to decline very quickly.
Yeah, looking at those earnings efficiency ratios is definitely a good point. Another thing you should consider is the style of investing and whether that complements your investing style. So, for example, if a fund manager's style might be focused on value, growth, or a market neutral strategy, you have to ask yourself, do you believe in this? And is this something that you're willing to support over the longer term?
Yeah, definitely, Jason. And from an income perspective as well, fund managers tend to pay most of their earnings out as distributions, and this allows them to have that attractive dividend yield, which are also fully franked as well. Hence, it's not unusual to see a high payout ratio for a fund manager, but this also means that the dividend will be moving with the market cycle, which can mean higher uncertainty around those dividend forecasts.
Yeah, good points, Ken.
Anyway, that's all we have time for. Thanks, Jace, for your insights again.
Thanks for having me. Always a pleasure to be on.
Yeah, and if you have any questions with today's episode, remember to participate in our Lincoln Live webinar this Monday. And as reporting season draws near, remember to focus on the managing the risk of your portfolio. That is, be diversified and stick to those financially healthy stocks. Have a happy, healthy, and prosperous week ahead.